that right. So when you log into your the latest version of the global markets version of the TWS, you should be able to get this. Okay, so what we are looking for is this. Look at this. We should be able to see somehow these dots are not coming right now. But just try and enter an order. Mainly we are interested in the stock, the underlying stock data and the stock option data. Okay, so take one of your trial accounts, and at least what you should get is, if you see when I mouse over here, it's not giving me the delayed data message. It's not even given the green and red buttons right now. Okay, so if we try and do a trade, the way to figure out if you're getting delayed data is, let's try and do a trade. Now I already have this long trade on gold. Okay, so let me try and let's say buy this is not the euro dollar, actually it's not gold. Okay, so let's buy another euro dollar. Okay, let's try and buy market, and this is getting entered into the Globex. Okay, so the order is filled. Okay, so which means that I did not get this message. If I get a pop-up, okay, if I get a pop-up, then obviously that would happen if you try to get somewhere where you don't have live data, like this one. Okay, here I don't have live data, so now I'm getting the pop-up. So you know how to figure out whether you have live data or delayed data. Okay, can you see this? Yeah, if you try to enter a market order, it will tell you. It should have given you a message saying yeah, we only have the euro dollar trade. Okay, so I think we can already see now, if you mouse over, you get that message. Yeah, this is what we want. This is what we don't want to see. Okay, we don't want to see delayed last available data is displayed. Another way to test for this is you try and enter an order, and if you have delayed data, this proves that I don't have delayed data in the euro dollar, because in the euro dollar futures I was able to buy a second contract and I did not get a warning message. So if you have delayed data, the system will give you a warning message saying that you are trying to enter an order in a market where you don't have live data. Okay, so it'll give you that warning pop-up. So that's another way to test that you have delayed data. So what we don't want is delayed data, we want to have live data. So all of this stuff, and just briefly, now you know why I said this to you, that whenever you're talking about the euro dollar FX currency pair, why you should always say euro dollar FX, because this is another contract that is called the euro dollar. Okay, so this is like the this is the interest rate futures contract, which is referred to as the 3-month euro dollar futures contract. Okay, which is a futures contract on 3-month euro dollar deposits in London. So it's an interest rate product. It's a totally different asset class. But if you just say euro dollar, I can't figure out what you're referring to. So that's why when you're talking about the euro dollar, when your intention is to refer to the euro dollar FX, the currency exchange rate between the euro and the dollar, you have to say euro dollar FX. Okay, and it's even better if you can, when you intend to refer to the euro dollar futures contract, the one I just traded in, okay, then you should say euro dollar 3-month interest rate futures contracts on the 3-month euro dollar deposits, okay, or 3-month euro dollar futures. If you say 3-month euro dollar futures, people will understand that you're referring to the interest rate futures contract. Is this clear? Now you understand the complexity of global markets, okay, how you have to be very, very particular about the use of words. Okay, so the first thing I want you guys to test, that at least if we know this for a few cases where people are able to successfully log in, okay, they should be able to log in, and then they should get, like when I mouse over here, I get delayed data. When I mouse over the crude oil contract, I'm not getting such a message. Okay, so this is live. Another way to test it is to try and do a trade. If we now go to Microsoft, some of these stocks that we are intending to trade, when I mouse over here also, I should get delayed data, unless they've already fixed it. I was actually getting delayed data. My account is quite old, I should not get delayed data messages. But when you mouse over like this, you should not get delayed data on the cash cash equities. Okay, this thing. And then you also want to do one more thing, which is you want to right click here. You want to right click here and open the option trader. Go to trading tools. Open the option trader. So you take Microsoft or any other example, and you open the option trader, and here too, you know where the prices are. By now you know where the prices are. You can see the bid and ask for calls and puts. Okay, you wait for this to load. So take a slightly longer maturity, and then when you mouse over these, it's still not loaded fully. When you mouse over this, also here bid and ask, you should not get delayed data. And in your trial accounts, and take one of the trial accounts and try and do a trade. Try and just click on the bid and ask, try and do a trade in the options. Okay. Again, if you don't have the live options data, again it will give you a warning saying that you're trying to do a trade in a market where you don't have live data. So what we want to do, is this clear? Message clear to everybody? Those who are able to log in on these new sets of accounts, you should now perform this test for the particular markets that we are interested in, both the underlying and the options. Okay, both the underlying and the options. We want to test and see whether the data is live for cases like yours, Anjum, Surabhi, where you are able to log in. And now test for live data. Is this clear? Do the test. Okay, some people here also are able to log in. So do this test. So this is our first test. So this is clear to everybody. Let's do that. And eventually everybody else also, once your accounts go live, everyone should perform this test. Nobody should be left with delayed data. Here, of course, you can see all the Greeks are not being calculated. These are called the Greeks. They're not being calculated because this market is not live. We're going to close this, and we are going to go to something where the market is open. We're going to go to the crude oil futures options. Okay, so let's right click on this and go to option trader. Have that open at least. Okay, so let that load. Okay, so then we go on to our next, let's get the crude oil chart also and see how it's reacting. So apparently this disruption in Saudi Arabia, this is affecting, I think this is affecting about 3 to 5 million barrels of oil per day. And they're saying they're going to be able to bring it back on stream within a month or so. But people in the market are not really sure whether this will come back. But interesting, you notice the reaction in the oil market. The price was here when the news came. And if you take 3 to 5 million barrels of oil per day from the market, that's quite a big disruption. Okay, but there still isn't enough. There's not a very large. If you really want to see from a weekly perspective, right? If you want to look at weekly data, can you see how small that is? I mean, given that there's such a big disruption in one of the world's biggest energy producers, okay, there you can see that the disruption is not very big at all when you're looking at it from the point of view of the big picture price movement. Can you see how small it is? Can you see that the price movement and the reaction to this kind of a supply disruption is quite small? Okay, so you understand the logic. So supply disruption should cause what? Prices should go up or down? When there's a supply disruption like this, so prices should go up or down? Up. Why? Because if supply is unchanged, ceteris paribus, demand remains the same, prices should go up. Okay, the basic supply demand logic. So one of the reasons why people are saying this is not going to, one of the reasons is, I hope you guys have been following the market commentary. This is what you have to learn, right? When you have events like this, you have to follow the market commentary and figure out for yourself what the market is saying as to why the price has not reacted much. Okay, one is that, what is that? Anybody has picked up on any of the points being mentioned? No one has picked up. So one of the things is a lot of the US has authorized the release of strategic petroleum reserves. Every country maintains what is called an SPR, strategic petroleum reserve, which is in cases of supply disruptions. We are also maintaining that. I think somewhere in the south, the Saudis are helping us to build that. we want to build a petroleum reserve because our oil may also be affected if there is war or some other disruption like this. So in fact, our supply is also affected. So there's something called a strategic petroleum reserve, which people keep inventories in stock. So if there is a disruption, they will release that. Okay. So the Saudis have released some of that from their inventories, and the US has also authorized the release of that. And then plus there is plenty of oil in the market. US production is also quite healthy. So that's why people are not so worried. And then there's also the matter of maybe further perception of weaker demand. So these are some of the things that people are saying, what they're discussing in the market as to why the prices are, because you can clearly see the price reaction is pretty muted. It's a pretty limited price reaction, right? Because people were saying this will go to $100 or $100 a barrel and all that, but that's not happened. So this is some of the stuff. So this is the kind of stuff that you guys have to pick up on, that you have to understand. You have to follow markets, you have to follow the news, see what is happening, see how the price is reacting, assess for yourself, is this what you would expect, or maybe you would have expected it to go much higher. Then what are some of the reasons people are saying why this has not gone higher and all that. So this has to go into your brain on a regular basis with not just this event, but everything that's going on in the market. Okay, there's another event that has happened in US money markets, which is quite significant. There's a bit of a funding crunch. So US money market rates are going up. So the US Fed is actually doing a lot of repos. There's some unusual activity. Normally in US money markets, you don't have any unusual activity. It's a liquid market and well regulated. But here there's some mismatch in supply demand. And so rates are shooting up. The Fed is doing lots of repos. Okay. So these things you got to know, because from all these events, you can actually learn a lot, especially at your stage. You can learn a lot from all these events about how markets function. Okay. Because this is the reality that you have to operate in. Okay, so you have to make sure that's why I keep telling you guys that you have to continuously, I can see clearly nobody's monitoring stuff. Nobody's monitoring the markets enough. Okay, you have to be monitoring, or this is your real learning of finance. If you do it this way, then you can go into your interview, you're almost like you've been working for 2 years on a trading desk. So that's what, because all the experience of the 2 years is already embedded in your brain, because you were living through all that. Okay, because you were following it constantly, etc. So anyway, so this is what you should be doing. But so we just have a little bit of a discussion on the oil price. You can see oil prices are here. At least now we can see this is what we were looking for. Actually, maybe it takes a little time to I don't know why this green and red is not coming. You notice here that you have these little dots, the tick dot that you get, these red and green dots that you get. Here you get a green dot, here you get a red dot, both are green. Okay, so that's a clear sign that the data is live. Okay, so if you see that, okay, so here you can start, so we'll continue with what we were discussing. I'm just going to cancel this.
Order cancelled.
Okay, so let's continue with what we were discussing. All right, so the TWS tasks for today, that's done. Okay, next is we continue with our models. Okay, with the decision problems that we are solving. Okay, so let's look at your spreadsheet, which is in your folder, which you can access, and we go to the DP4 paradigms, which is, okay, we would prefer to call this buy-sell paradigms. Okay, Garvit, you monitor, make sure that not more than one person goes out at a time. This is a dangerous monitor. There is an expression, have you heard this expression in the English language? That the wolf is guarding the hen house. Okay, so this is like the wolf guarding the hen house. Why do we need to make it so small? Actually, I don't know why this is. Okay, so what we're going to do is we will not worry so much about TA. Can you guys on the last bench, can you read it? You're able to read all this stuff? Like value agnostic and all, you can still read the font? Okay, that's good. Okay, so the reason I showed you this framework essentially is just to first to understand, first to drive home the difference between what we discussed here, which is when we were talking about option valuation models, okay, so which is that the concept of fair value and the concept that value is subjective and that price is objective, okay, and essentially what we discussed a little bit about that, okay, so we continue with that here. So we have to stop actually, so if we talk about fair value models, okay. So what you have to understand that all these models that you have been that you've already covered in your FM1, FM2, okay. Do you realize we discussed this briefly the other day that you realize the basic structure of these models are all the same, right? The basic structure is all the same, which is basically what we have is, if we can just write it down, okay. So these are what I call forecast-based models, okay. Let's call them. So these are forecast-based fair value models. Why am I calling them forecast-based? Because I'm going to later on distinguish them relative to this other class of models which we are calling arbitrage-free valuation models. Okay, this is AFV, stands for arbitrage-free valuation models. Okay, so typically if you'll notice now, some of you guys, like Saloni was saying, couple of the other guys are doing some course which you passed up on. Who's doing those courses? Tanya is doing it. Yeah, just give me the outline of the course. Just give me what the syllabus is. Okay, so you will find typically most of these courses, I've studied some of these courses. Now typically what they do is basically what you'll be doing with DG sir in your corporate finance modeling course. Okay, so this actually gives you a slightly, most of these courses are doing this, and they're calling themselves financial modeling courses. That actually is not a correct term, because the DG sir's term is more correct, because he's calling it corporate finance modeling, which means it's like if I give you only dosas and sambar and idli and I call it Indian food, that's not correct. I should call it South Indian food, right? That would be more appropriate. So you're only actually doing one type of model, which is basically what I am calling those forecast-based valuation models. And usually what you're doing is, mostly in the case of stocks, mostly you're applying it to value stocks, if I'm not mistaken, from the syllabus, from the syllabi that I've looked at. But the important thing to understand is basically that we call them, I'll explain to you why I call them forecast-based. These are forecast-based because the other class of models, the AFP models are, strictly speaking, not based on forecast. These are not based on forecast. So here you have a classification in this value versus price box. In this value versus price box, you have two subcategories. One is the AFP models and one is the forecast-based valuation models. Okay, all right. So so I have to now deduct 2 marks for. I have to deduct marks for Hardik and Tarun, because they were obviously sharing some joke. So we have to add some VIPs for today. Yes. Okay. So the point, the scheme here that you see, this is there in your folder. You can see this, you can access this file. You can see the breakup. The first breakup we have done at a high level is that, how do you solve these, how do you solve the fundamental buy-sell decision problem? You have two approaches. One is you can take the TA approach, okay, in which case you're not at all concerned with value. You're just looking at price patterns and trying to predict, and you're doing some price-based calculations like moving averages and stuff, but you're only concerned with the market price and price derivatives, okay, and other stuff like volume, which is all basically market activity. But here, when you're looking at the other approach to solving, so these are two different approaches to solving this problem. And the other approach is basically where you are going to compare, you're going to compute this special thing called fair value. You're going to compute the special thing called fair value, and then you're going to compare it to the price, and then you're going to take the decision. If the price is below the fair value, you will buy, and if the price is above the fair value, in general terms, you will be a seller. Okay, but some places like value investing in equities and all, typically a guy like Warren Buffett, most famous value investor in equities, he does not really sell. He maintains a long only portfolio. He does not go short. So if he thinks something is overpriced, he won't buy it, that's it. But he won't sell it. He won't go short. He won't go net short. So, but in general, this value versus price paradigm is that if its price is above value, you sell it. If it's below value, you buy it. So you understand the basic difference. Here, this concept of value doesn't come in at all. And what you have studied in most of what people study in most basic finance courses is all this kind of all these things. All this actually fall into this box, okay? And the important thing the reason we go through this, the reason I'm going through this framework is because you need to understand that all this stuff that you did, this bond valuation, stock valuation, NPV, why is it relevant? Okay, it is relevant because it is one way to solve this buy-sell decision problem. Are you following what I'm saying? This basic thing, because usually what happens is the valuation thing falls from the sky. Okay, we are doing valuation, we are doing project valuation, but why? Basically, the reason you're doing it is because it's one way to solve the buy-sell decision problem. Are you following what I'm saying? I'm making the connection to a decision problem which is normally not made. Okay, so we'll see this in greater detail later. Right now I'm under a little bit of pressure to get into your option trading framework because the project needs to start. But this is the first thing. And the second is, within this value versus price comparison paradigm, we have a further classification of those which are based on forecast-based valuation, and those which are arbitrage-free valuation, which is basically not based on forecasts. Yeah. Sorry? You want to increase the zoom, you want to basically increase the magnification a little bit. Yeah. Now it's okay? Yeah, because we don't really need to look at the TA details right now, all this other sub-classification within TA, because we are not studying that right now. Okay, TA is a subject by itself. You can actually have 3 courses on TA itself. Okay, there's so much material. Yes?
We have done only one.
We haven't even done, at least in DSB, we haven't done even one on TA.
The first one you
Yeah, I have given you some idea about TA, okay, how to apply a TA based approach, but that's a very basic approach. It's a solid approach actually, but it's a very basic approach, and what I have told you to do, you can apply it both as a momentum trader and as a mean reversion trader. But what I have taught you is actually falls into this. Essentially, it falls into this box. Within TA you can have all these classifications. So I haven't taught you anything to do with the mechanical trading systems. Okay, I haven't taught you anything to do with that at all, but I have only taught you the kind of system that I've taught you, like the stuff like the high low, the basic definition of a trend, okay, and buying with new highs, etc. That really falls into, and I've told you to apply it on multiple time frames. Okay, you look at the big picture trend and the small picture trend, etc. Okay, I mean the small the micro trends. So that's actually that's an approach which falls somewhere here. Basically, that idea comes from Dow theory. Okay, so what I've taught you really falls within this. So what I've taught you in TA is also a very small subset of everything you can do within TA. Okay, but that's a valid, whatever you've covered is very useful in the real world. Okay, you can use it to manage risk if you follow the rules properly. Okay, so we are now in this box, so we're not so concerned with TA, we are in this box. Okay, and what we are saying is that these are forecast based fair value models, and then there's another class of fair value models which is the arbitrage. AFV stands for arbitrage free valuation, and we can just put these notes here that FBV is so we don't need to write this and slow down. I mean, that's the whole point of doing the video, is that, you know, I can save a lot of time because I don't have to write down all this stuff. Okay, so this AFV stands for arbitrage free valuation, this stands for forecast based valuation. So the implication is that this is not based on forecasts. So we'll come to these details later, but you should understand when you're doing these courses that typically you're doing only one class of models. There are many other types of models. Typically you will not cover arbitrage free valuation models. Okay, so it's like you're eating South Indian food and people have told you it's Indian food, and all you're eating is upma and you know, that uttapam and dosas and idlis. That's all you're eating. Okay, so now we have to understand. Now the other thing, the last thing I would mention when you're going to be doing this course with DG sir is, please understand that these forecast based valuation models, they are all based on the same basically you're talking about NPV, Gordon growth model, okay, etc. Okay, all this stuff, bond valuation, okay, basically the structure, the steps are basically, if you look at the steps, they have the same structure, same basic structure. So if you're doing a forecast based fair value model, it has the same basic structure, which is, we will just write this down so that you're clear, which is, what is the first step? You forecast the periodic returns. Okay? Yes, clear? You remember why I use the word returns? I don't want to use specific terms like dividends or interest coupon payments, because those will tie us into equities and bonds. I want to use a general expression like returns. So under returns, everything is covered. Bond coupon payment is also a return. Dividend from a stock is also a return. Cash flow from a project is also a return. Everything is covered under returns. So if I say returns, it's a general expression which covers all kinds of returns generated by any asset. So we want to use general. So the first step is you forecast the periodic returns. You're all familiar with this. If you're doing a project, you're forecasting the period returns. Okay. The second step is basically discount the periodic returns. Okay. So obviously, or let's make it even more. Discount and PV. Okay, so PV means you find the present value of those periodic. So a 7-year return, obviously you will do 1 plus R to the power 7, okay, and so on and so forth. Okay, so nth year return. So that when I say discount and PV the returns, it includes all this. That you 7th year you discount 1 plus R to the power 7, 9th year is 1 plus R to the power 9, and this manner. This is clear? Everyone is following? Second step is this: discount and PV the periodic returns. We can make it. Is this clear? Second step is clear. Discount and PV the periodic returns. The same. It's very simple actually. We need not even have written it. But since I found some, I just want to make sure that basics are clear for everybody, and then add the PVs. Is this clear? So one of our previous prime ministers used to be very big on this project analysis because his name was PV Narasimha Rao, right? So that's why. Okay, so then you add the PVs. Is this clear? Chuk got the joke before I even, which obviously nobody else found it funny, but Chuk understood the joke before. Chuk understood the joke before it was even cracked. Okay, so is this clear? Yes? Clear now? Okay, so this is a very simple structure, but the point is, maybe you're wondering why are we spending time on such basic stuff? Because I just want to make sure that you understand that this is all the same. You may have done bond valuation separately, you may have done a stock valuation separately, then you've done your project separately, but you have to understand that these are actually all the same. Okay, so later on we'll do some further analysis on these. I'm going to spend a lot more time on basic definition of models and stuff like that. How do you define a model? Okay, what are the various types of models, the taxonomy of models? So we'll spend more time on that right now. I just wanted to introduce the idea of fair value and the concept of forecast-based fair value models. So you should understand that this kind of landscape exists. There's another category of models which I have not put here, which is I'm going to add that to the framework later, which is your regression models. So slightly different from the forecast-based models, okay, because they're not really fair value models. They're based on slightly different assumptions. And then you have, in economics, you might have heard about general equilibrium models, which are based on simultaneous equation systems. You know simultaneous equations? What? You've never done simultaneous equation systems? Simultaneous equations in mathematics you never did. Okay, I don't know what's happening nowadays in school, but I don't know. Anyway, so you have, the point to be aware of is that when you do a course like financial modeling, and actually what you're doing is only this, you should be aware that there are many other types of modeling. Okay, so the universe of models in finance and economics is very wide. Okay, it's a very broad universe. There are many types of models, and when you're looking at something like say option pricing models, they actually fall under the arbitrage, the AFV category. But within AFV also there are two subcategories. These are not proper AFV models. Okay, these are improper AFV models, and then there are proper AFV models. So we'll do the entire classification later, but you have to be aware that you should be aware that the universe of models is quite vast, and you need to have a good definition of what is a model. Okay, and you need to have a good taxonomy of models. You need to understand all the different types of models that exist. Okay. So okay, now let's go back to this. I think we have this idea, and then the other thing that I wanted to just drive home is the fact that these are all the same. Okay, these forecast-based valuation models have the same structure. Okay, we'll come back and deal with later on why. Does anyone know what is the difference mathematically between a project? You know the IRR of a project? Have you done the IRR of a project? You've also done the YTM of a bond?
Yes.
Okay. So mathematically, what is the difference between these two? If we take a project and we take the IRR of a project, and if we write down, we can write this as homework or something. We can write this query project. Okay, we'll write it in. You can think about this question. We'll address it later. Okay, when I come back and continue with the module on models. Okay, we'll continue with that. Now we'll come back to the options module because I am concerned I have to get you guys ready for the project. Okay, so we are exiting from our discussion of models by leaving you with one question which you can think about is what is the mathematical difference between the bond YTM and the project IRR? Okay. So you can think about that. We'll come back to that, and then we leave this now. We go back to our option discussion. Okay. All right. So we have this. We want to talk about. Yeah. So the correct term is actually the whole discussion on models started because although something like this would be referred to in the industry as the option pricing model, I'm just coming to you. It is actually an option valuation model. This is actually a category of fair value model. This is actually a fair value model. Okay. So here, what you see here, these are both fair value models. Okay. So whenever you're doing a value versus price comparison based analysis, you're working with a fair value model. Then it either might be a forecast based fair value model or it might be an AFV model. Okay. So the option actually, an AFV itself has two categories. So the option actually falls over here. Okay. It's supposed to be, it's a fair value model. It's not actually it's a valuation model. It's not a pricing model. Okay. Pricing is something that is done by the market. Yes. Gulati, what is the question?
Sir, you gave us a homework regarding project IRR and bond YTM.
Yeah.
And you wanted to want to know the mathematical difference. So, is it regarding the formulation or something?
No, mathematical difference. Mathematics is only always formulas and mathematical expressions. You can't do mathematics in words. No, like I went to the market. You can't do. That's not mathematics. No, mathematics always has to be with formulas, expressions. That is what I'm saying. Mathematical, you think about the formula aspect. Is this clear? Is my point clear? Okay. All right. So that's the point that we were making when we came here. Okay. So we want to now go on to right. So okay, so before we come to now, let's do the decision problems now. Okay, so you guys are already familiar. We've covered the question on the aspects of an option contract. We've done this question. We've done this part, right? We can make it 14. We already did aspects of an option contract. Now, let's go back to the decision problems where we are already familiar with the historical decision problems. By the way, just let me mention one thing I noticed while correcting the papers. Many of you are very callously using, this is why I emphasize, using, I mean, this is not the only category of error that I found, okay? Because most people have failed to factor in the exit price. in the calculation of the position size. That if you are trading dollar Swiss and your PNL is being generated in Swiss francs, okay, you can't take a Swiss franc PNL and compare it with a dollar a dollar risk per trade. So that comparison, that needs to be preceded by a way to convert the Swiss franc amount into a dollar amount by dividing it with the exit price, dividing it by the exit price, because that converts that is the value of the dollar Swiss, that is the dollar Swiss exchange rate at the time that you realize the loss. So therefore it has to be converted, the Swiss loss has to be converted into a dollar loss by using the dollar Swiss exchange rate. Okay, so some of you have done it, but very few have done it. Most of you have made these kinds of mistakes. So that's one category of mistake. The other category of mistake I noticed is, even when people are discussing a dollar Swiss problem, I've asked them for the amount, for the position size in a dollar Swiss trade, and people are writing number of shares. Why are you writing number of shares? It's not number of shares, it's the amount of dollars that you're going to buy. Okay, so why people are just mechanically, I've seen this in many cases, people are just writing number of shares. This is because you're not thinking about what you're writing. And I've noticed, at least in this country, where people are, whenever they talk about financial market, they always say stock market shares, stock market shares everywhere, you know. But that's not correct, because as I've told you, as I've shown you, there are many important markets, okay, many asset classes. So you have to get out of these. You should not be making these kinds of mistakes. When I'm asking you for a dollar Swiss amount, a dollar amount, why should you write number of shares? It's the amount of dollars, right? Okay, so decision problems, let's go back to decision. We're already familiar with these decision problems, okay? Now, in the case of options, okay? In the case of options, we have some extra decision problems. Remember when we were talking about, if I'm trading oil, if I'm trading just oil futures, okay, I just need to worry about whether I should buy or sell, okay, and whether at what price, then should I enter at the current market price, okay, or should I enter at a more favorable price or a less favorable price using a stop order like a Donchian trading system, etc. Okay, but if I'm trading oil options, do I have some additional decision problems? Is my question clear? Because see, if I'm trading oil futures, okay, let's say that on this buy-sell question, I decide that this is, I look at this big picture pattern, and then I move into a smaller view, which is here, let's say on 4 hours. I look into a smaller view and I say, let's say for whatever reason, I come to the conclusion that if the price is not reacting to this kind of a bad news event, then the market must be really bearish, okay? So I want to go short at the market, okay?
But sir, there is an uptrend.
There is an uptrend, yeah, but you could also look at this and say, I'm just saying, I'm not going into the details of whether my decision is correct or not. I could also look at this and say, this is a high, this is a low, high, low, this low is lower than this low, so there is a downtrend. I could also say that this low is actually lower than this low.
That is before the strike. That is before the strike on oil. That low is before the strike on oil.
Yeah, before the strike on oil.
After the strike, it can
Yeah, you can say that. You can do whatever. So if Choga is more comfortable buying, we can buy, no problem. We will just say, let's say, the point I'm trying to emphasize is this, okay? So let's say we take Chok's analysis and we decide to buy, okay, because we think this is going to cause a major supply disruption, and the Saudis will not be able to bring it back on time in 1 month, okay? And then maybe there's some more attacks coming, okay? Because apparently what they discovered is, because there's a civil war going on in Yemen, right? You following all this news? There's a civil war going on in Yemen because again the Yemeni government is actually, so this whole Shia-Sunni conflict in the Middle East, okay? Because Iran is a Shiite state, most of the others are Sunni states, at least the rulers are Sunni. So Saudi, Egypt, Emirates, these are all Sunni states. Even Yemen was ruled by a Sunni ruler, but there's a major civil war. These Houthi rebels are being backed by Iran. Okay, and so there's a civil war going on in Yemen, which is to the south of Saudi. So they've been firing missiles earlier. So what the Saudis had pretty good air defenses. They had a lot of US Patriot missiles, but they were all pointing south. because Yemen is to the south, but Iran is to the northwest of Saudi. So the missiles came from these cruise missiles which attacked the oil fields. They came from the north, so they were not prepared. They never thought that Iran would actually launch attacks against the Saudi oil fields. So they didn't have, the Patriot missiles were all pointing south. So I believe they have fixed that now. So these are, so the point is that you could always say that there could be some more attacks. Maybe they'll launch a swarm of drones, etc., which will penetrate the defenses. So anyway, so Chuk wants to buy, so let's buy at 58.60. I'm buying oil. Okay, I'm buying oil futures, and I'm putting a stop here. Okay, let's say at 54 or whatever. So we are buying at 58.60, putting a stop at 54. So we've solved our buy-sell decision problem, right? Now my point is that if we were trading in oil options, instead of trading in oil as an underlying, okay, in this or oil futures or spot oil, we want to now trade in oil options, futures options, let's say, okay, or just let's forget about the futures options, let's talk about oil options. Then do we have some, my point is, do we have some additional decision problems to make? I mean, additional decision problems to solve. Do we have some additional problems? Based on what you studied in aspects of an option contract, do we have some additional problems? What are the additional problems? Yeah, so what I'm saying is extra decision problem. In the case of options, what Tanya has mentioned, one point, she is talking about expiry. Because as you can see here in this thing, how many are we talking about? We can have all these other expiries, okay? I can have September 2020, okay? I can change the expiries. You can see all these different options that are available. We have, okay, so we can make March 20, okay? So can you see already in this view itself there are 2 expiries shown? Then you can actually have many more expiries. If you look at something like this, if you look at SPY, so the first point that Tanya has mentioned correctly is that it is not sufficient to just say I'm going to buy oil, or I'm going to sell oil. Okay, that we do. That's what we've been doing earlier, which we just did in this exercise. That solves the problem. If you are trading in spot oil or oil futures, okay, oil futures also actually you need to take a active contract decision. But let's assume that it's a spot oil. We are doing spot oil trading. Okay, so we don't add the additional complication of futures. So in the case of spot oil, we just buy and that's good enough. Okay, but in the case of options, that's not good enough because there are many different expiries. Okay, as you can see here by clicking, these are all the possible expiries. Okay, all these possible expiries are there in the case of oil options. Okay, futures options. So now the question is, so therefore you have to decide the expiry. Okay, this is clear? Are you following what I'm getting at? If I go to options, this is what market, this is the spider. Okay, this is the SPY ETF. Here also you can see, I would like to go to straddle view. The straddle view is when you show the puts and calls side by side. Here. Okay, this kind of view is called a straddle view in the case of options. Okay, it comes from a strategy called the straddle, which we'll do later. Hopefully we'll have time. Here also you can see that if you want to trade in SPY options, what is the market saying? What is the software asking you to enter? It wants to know which expiry date do you want me to display the option prices for. Okay, because each display, this is for September 20th. Okay, this is for September 20th, so this is too small, very short term for us. We don't want this. We want to change it. You'll notice the prices will change. Okay, this will update and then the prices will change. So now you're looking at options for 25th October. So the point to understand is that there's expiry is a decision that has to be taken. Okay, that's one. Okay, what else? Strike price is also another decision. Very good, because even when I have fixed the expiry, let's say I want to trade for the 180-day options, a 6-month option. Even when I'm looking only at 6-month options, I have a whole bunch of strikes. When I'm saying buy an option, okay, let's say we take the corresponding view from the spot market decision. Spot market decision, Chok told us we should buy. So that decision is solved now. That decision problem is solved. So if we transfer that to the option market decision, now we see to the option market, now we see that just to say that buy an option is not good enough, because we need to know which expiry are we going to buy options for, because there are different expiries. Okay, we also, when we look at a particular expiry, we see that, oh my god, there are so many strikes, so which one should I buy? Okay, which strike? So strike price is another decision. Okay, now what else? Quantity. Okay, quantity we already have listed as a separate decision problem. We are now just talking about, yeah? One minute. Let me just talk about let me highlight the problems, okay? In buy sell, there are like extra decision problems. So entry price is one level problem. This exit price with loss, exit price with profit, number of units is a decision problem, okay? Actually, number of units also, as you discovered towards the end of your previous course, there are actually two different types of broad problems to be solved: initial position size and the pyramiding decisions. Okay, pyramiding positions, when you have a second category of decisions, when some of the positions may be in profit, some may be in a loss. Okay, how to adjust the position size. So basically, essentially what you have is, when you have all previous positions are in a profit, okay, then the decision is, the way to solve it is exactly the same as the initial one, because you just take the total risk capital per trade, total risk per trade, and you then figure out how many units you can buy, okay, or sell. Because you are not, when all the previous units are in profit, okay, you will not adjust the profit against the risk capital allocation for a trade. Okay, so pyramiding, we can just put it as two subclasses of decisions, where we can, just to make it distinct, although essentially it is of. So even within pyramiding, you have two subclasses of decisions. Okay, one where all the previous positions are profitable, and one where some are not profitable but some are profitable. Okay, so against the latest stop loss that is going to be used. So within position size also, you have actually got two types of decisions. So we've seen that as well. Now we are talking about options, and we are going back to the buy sell decision, and we are saying that it is not sufficient to just say I want to buy an option, I want to sell an option. You have to specify the expiry date. You also have to specify, within the expiry date, you have to specify which strike, right? Is this clear? Are you following? Everyone following? How the decision problems are increasing in the case of options, okay? Because options are more complicated as an instrument. Ideally, what we would do is, actually this year they have shifted FDRM as to the second course. So typically we do IFM second, and then we can cover futures and forwards and swaps and all that. And then we typically prefer to cover options last. But since it's come here now, because options are the most complex type of instrument. But since it's come here to the second course now, so we have to just do it here. So you have to understand options. So many strike prices, you have to decide which strike you want to buy. Okay, so remember, our decision from the spot market is to buy an option. Okay, so now we have fixed the expiry date, 180 days option, and on the strike, let's say we decide what is the actual, right now the price is around 59, so let's say we choose an at the money strike, we choose 59. Okay, is there any other decision that we have to take?
Yes, sir.
Call or put, right? You can see I was giving you a hint by doing this, call put. Okay, this is like that Ajit, when he's giving his signal, tumhara signal hoga on off, or your signal will be off on. So we are giving you that call put, right? So anyway, so that this call or put, I was giving you a signal here. So call or put also has to be decided, right? It is not so, yeah.
Is this call and put decided along with the decision of buy and sell of the?
Okay, so that's a good point. That's a good point actually. That this call and put will be decided also whether you're based on your view. So you are actually leading us to the whole decision-making matrix in the case of options. Okay, but you're right. But at the moment, we'll just address it as a superficial level. That since we have decided to buy, since we have decided to buy, okay, at this level also the listing of the decision problems is fine, okay, that you still need to decide whether, if you're going to, given that you want to buy an option, you still need to decide whether you want to be whether you want to buy a call or a put, okay. So this is another decision that you have to make, call or put. 1 minute, Tarun, I'm just coming to you. So call or put also has to be decided. Okay, yes, Tarun, what is your question?
So buy and sell doesn't determine the price, that is call or put, but exit and entry price defines call or put more better.
1 minute, I'm not able to follow what you're saying. What are you saying?
Actually, buy and sell refers to only whether we should go into the market or not, whether we should go long or short.
Okay.
This is what is buy and sell.
Yeah.
Whereas the price is defined by the entry price and the exit price.
Okay.
So call and put here is defining the price or the position to go long or short.
No, more like the second part than what you mentioned. Actually, what you mentioned is you're correct that the price will. We are still not talking about the price here, because the price is again going to take us to our old decision problem of entry price. Should I enter? When I see I'm looking at a bunch of option prices here. Suppose I decide to buy the 59 calls. Suppose I decide to buy the 59 calls. They are trading at 401, 410. Okay. Now I can decide. Now this is the market price for me if I want to buy. Okay, I can decide to buy at 410, or I can, which means case I place a market order, or I can decide to buy at with a limit order at a price less favorable, more favorable than the current market. So I may place a limit order to buy this option, the 59 call for March, April 2020. Okay. I can place a limit order to buy. The right price now is 409. Okay, I can place a limit order to buy this at maybe 390, 3.9. It's 4.09 right now. I'm not happy to pay I'm not willing to pay 4.09 for this call option, but I'm happy to buy this call option at 3.9. So I can place a limit order to buy this call option at 3.9. That would be a limit order. Or if I want to use, a Donchian style trading methodology with respect to option prices, okay, then which is very unusual actually. That is used typically with futures or spot, etc. So, but you could still technically do it if you have been plotting the price of this option. You have all the 4-week highs, okay, and if you feel the 4-week high will be broken at say 425, you can place a stop buy order for this call option at 425, 4.25. which is, that would make you enter the position at a price less favorable than the current market price. So that would be via a stop order. Are you following? So is this response that I gave you to your question, does it answer your problem? Does it address your problem?
Actually, I was asking...
use the mic, if you can use the mic. Let's have... Yeah.
So what actually I was asking is, how is it related to buy? Is it related to buy or sell, or is it related to exit and entry? Like price, it is related to price or to the position?
At this point you don't worry about price, because what am I doing here? If you notice this part here, what am I doing? We went back to our original list of decision problems, okay, which we had already identified earlier. If we make it a little smaller to capture everything, we went back to our original list of decision problems, which is this is anyway in your notes, okay, this is in your version of the notes, the outline notes. So then we are trying to introduce this idea that when you start talking about options, it is no longer sufficient to just have those particular decision problems that we had identified earlier. There are going to be some additional decision problems that have to be solved when you are trading in options. Okay, and those we are introducing. You notice I'm putting this extra DP under options 1, 2, and 3. I'm putting it under the buy-sell under the buy-sell decision. So these are like sub-decision problems, you can say, in the case which only arise in the case of options. Okay. Well, technically under futures also you have an expiration decision, which we'll come to later. But we'll just so I won't make that second strong statement that it only arises in the case of options, because expiry will arise in the case of futures also. Okay. But these three problems certainly exist in the case of options. That when you've decided to buy, you have to also decide to the expiry date of the option, because there are many different expiries trading. You have to decide the strike price. You have to decide whether it's a call or put that you want to buy. Okay, is this clear? Does this solve your problem now? Now the point that Tanya has raised is an important point that will bring us to the option decision making framework, okay, which we may come to at a little bit later. But this is one thing that we have understood now, that in the case of options you have three additional decision problems. Okay. So let's now talk briefly a little bit about some of the other aspects. We can go back and increase the zoom a little bit. Yeah. Okay, so the next point that we are discussing is something called moneyness of options. You can find this in some of the links. The CBOE link is a good link actually. If we go back to, so we solved the problem of decision problems. The next topic we are talking about is moneyness of options. Decision problems we have already discussed. Okay. Then forecast based valuation model is our first topic for today, which we continued. Okay. Then we have decision problems, which we discussed. And the next topic we are discussing is something called moneyness of options. Just very simple stuff. We'll just go through it briefly, then you can revise it from your CBOE. All these websites you can explore. These are good websites, what we have at the top. I think here, I gave you all the links. These are all good websites. Again, remember, don't go here and there, Investopedia and here, there, look around on the web. Follow the links that I'm giving you. These are certified links. These are good quality links. Okay. So CBOE options education, here you'll find good information. There's an options quiz also, I think, under options education. You can take that quiz. Okay. So these are all the sites. You can go to CBOE options education, find out what about all this. So the topic that we are covering is simply this. You can just read this. You'll find this chart also in the, I think, in one of those links. Okay. So in this case, essentially we have, first let's decide one thing, which is, let's define intrinsic value and time value. This is also actually from we're talking about moneyness of options. Within that, we are covering this other topic, which is option intrinsic value and time value. Okay. So now, if you look at, is anyone familiar with these terms? What do these terms mean? Okay. So essentially, intrinsic value essentially is nothing but this. You can see this. You'll find this chart in the options education website, okay, on the CBOC. So intrinsic. So we are defining. We're essentially saying that the value of every option consists of two parts: the intrinsic value and the time value. Okay. This is one of the reasons why, even in the case of American options, okay, even though American options can technically be exercised early, okay, most of the time early exercise is not optimal, because if you exercise early, you'll be giving up the time value. There are certain exceptions, like in the case of American style options on non-dividend paying stock, where there's a long period left to maturity and interest rates are very high. Those are some specialized situations, but in general we don't exercise early. Okay, we sell the option, because if you exercise early, you lose out on the time value. Okay, if you exercise, you basically capture just the intrinsic value. So intrinsic value, you can see what it is. Very simple. The current, now again, they have not defined it correctly. This should have been the asset price, because they have defined it only for stocks. It's actually the same for any asset, options on any asset. So this stock should be read as current asset price. Okay, so basically you can say IV, if you write this down, IV is intrinsic value. IV is basically current, let's put it as current underlying price. Okay, and you can just take the absolute value of this. strike price. Okay. So if you write, so this is the intrinsic value. Okay, basically the difference between the underlying price and the strike price. Okay, so in this case you can see typically you would say that if you have an option here, if you have so intrinsic value, we don't say that the intrinsic value is actually if you say intrinsic value is, we don't say it's negative, okay, because the option value will not reflect the negative part, it will reflect, so we either take it as 0 or positive, okay, essentially it should be either 0 or positive. Okay. The point I'm trying to emphasize here, we normally don't take, because we are talking about the value of option, the value of option will not go negative. Okay. So essentially it's either 0 or positive. Okay. So if it is negative, we say essentially for all practical purposes it's 0 essentially. Okay. Because this say if you look at the underlying right now, it's around 59. Okay. If we add okay, so if we take the 61 strike, now the underlying is around 59, so this 61 strike, okay, if you look at the 61 strike call, okay, if you look at the 61 strike call, this is basically, what is the intrinsic value here? Essentially the intrinsic value of this call is 0. Okay, we won't say it's negative. Okay, essentially what you do is in intrinsic value, what you do is, in order to find IV, okay, to find IV, ask what money you can make by exercising the option now. Okay. Okay, so ask what money you can make by exercising the option now. This is what you need to remember for our intrinsic value. Okay, so if I exercise this option now, how much money can I make? Okay, and we only say, basically we only think of it as 0 or positive. Okay, because nobody is going to exercise an option and make a loss. To make a loss, nobody is going to exercise an option. Okay, so therefore what we say here, if you look at the 61 call, so let's practice intrinsic value here to understand the concept. The underlying is at 59. Okay, the 61 call, if you exercise the 61 call, what does it give you the right to do? To buy the underlying at 61. So the 61 calls gives you the right to buy the underlying at 61. Now why would you exercise the call to buy at 61? Because the market is 59. If the market is 59, why would you buy it at 61? If you buy it at 61 and exercise the option, you will make a loss, right? So in this case, we say this option has no intrinsic value. Okay, so this is basically should be understood as essentially what profit can you make by exercising the option, and if it's negative, we say we just treat it as 0, because if we want to say that the value of an option is equal to, mathematically we want to say is equal to the IV plus the time value. So in that case, we don't write, for the value of an option will not go negative, so we don't write the option, therefore in that expression we don't write IV of negative, we don't write a negative IV. So for IV, essentially what we are trying to think about is, what money can I make if I immediately buy this option and immediately exercise this option? You understand? Everyone knows what option exercise is? Is everyone clear? Yes, SG1? Yes. Exercise of options, you know? Okay, everyone is clear about exercise of options? So if I exercise the 61 call, that means first I'll buy the call, then I'll exercise the call. So I'll buy the call first by paying this money, 332, and then I will exercise my right, which will enable me to buy the underlying at 61. But then I'll have to, when I go through this exercise, I want to imagine that I also sell it off in the market. I don't have a position at the end of the exercise. So I buy the underlying at 61 and immediately I sell it off at 59. Yes, so I make a loss. So therefore here I consider, for the option formula part, that option value is equal to IV plus time value. There we write the IV as 0. We don't write a negative IV. So this we treat as, this option has only time value. And out of the money option essentially has only time value. This is clear? Because we are saying the value of an option is equal to IV intrinsic value plus time value. This is clear? So when the intrinsic value we find is actually negative, we say this option has no intrinsic value, okay, and it has only time value. So here we know one thing, that because you can see the option has many days to expiration. So although this option has no, this is something interesting to look at when you look at the prices of out of the money options, okay. So essentially options that have no intrinsic value, they are called basically where they have negative intrinsic value. If you calculate, if you actually did the exercise, you would lose money, okay. Those options are called out of the money options, okay. Those are out of the money options. So if you look at out of the money options, this is useful. Like the 61 call right now is out of the money. Is everyone clear? So essentially those options where if you buy the option and immediately exercise it, you will incur a loss. In those options, we say those options are out of the money. Is this clear? You would incur an actual loss, a negative. Okay. So all these things you can, you will also be able to read from these links. Options Education, the very good website. Okay. So is this first point clear? We have defined what is intrinsic value. You know how to calculate intrinsic value. Basically, you ask yourself, if I buy the option right now and immediately exercise the option, then what amount of profit or loss will I make? If you make an actual loss of some positive amount of loss, I mean in the sense that the absolute value of the loss is positive, okay, so you make some loss. It's not like a zero, it's not like what we call NPNL, which is no profit no loss. It's not a break even, it's actually a loss, okay, it's some magnitude of loss. So if you make that, we basically treat the IV as zero, and that kind of option we call an out of the money option. The logic is also quite clear. You're not going to make money by exercising that option, so it's out of the money, okay. All right, so when you look at out of the money options, you can see also one interesting thing about options. This 61 call should have no value then. Strictly speaking, this 61 call, and if you know these are all real market prices, the 61 call should have no value, because by exercising it nobody makes any money, right, logically. But the reason this has value, this is called time value, because this option has 180 days, 6 months approximately to maturity. So in 6 months time, all kinds of stuff can happen in the oil market. The oil price can shoot up to 100, okay. So then the 61 call will have value if the underlying shoots up to 100. And if you buy it now, okay, you will still be holding on to it, because you have a 6 month, if you buy it now, you have a 6 month call. Struck at 100, we say it's struck at 100, the strike price, sorry, not 100, struck at 61 basically. The strike price is 61, you have a 6 month call in your hands, which you're holding on to with a strike price of 61, gives you the right to buy the underlying at 61. Now if suddenly some more attacks come or some other disruption happens and the oil price shoots up to 100, now you can make a lot of money, right? So this time value essentially reflects that risk. That's why you can't buy this 6 month option for free, even though you can't actually make any money exercising the option right now. It's out of the money. The out of the money option has value because of time value. Because this is the time, this entire 3 month, the same thing if you look at, okay, if you look at the same thing for a 147 day option, let's do the same exercise. So everyone follows 330 is what I have to pay if I want to buy a 61 call for 6 months, okay. Now if I look at the same 61 call, if I go to 147 days, I thought I just clicked on 147 days. And somehow it's not responding. No, it's not. For some reason. There's a little bit of a corruption in the display also. But anyway, Feb 20, March 20, if I take Feb 20, March 20, so this system seems to be hanging because it's not really responding. There's updating. But anyway, the point is that you will see that if you look at the same out of the money option, okay, if you, now we're looking at a 180-day price. If you reduce the time period, the time value will increase or decrease? It will decrease, right? Because the time is now less. For it to go to $100 and do all kinds of funny stuff like that, the whole time period is much less. Okay, so the chances of that happening is less. So in general, your time period will, when you reduce the time period, the time value will reduce. So you've learned a few things now. You learned the concept of intrinsic value, how to figure out intrinsic value, and what do we mean by out of the money options, that those which have technically a negative intrinsic value, where you would actually make a loss by exercising it. So there we say those are out of the money options. Okay, and then we can now use this concept. And then you can also see that out of the money options have time value, and the reason they have time value is because those options give you some kind of an insurance policy, okay, that the price may suddenly move in your favor, okay, the underlying price. So therefore you would you still have a chance to make a profit. That's why you don't get to buy it for free. Okay, so there you have out of the money. Now can we also define quickly now, therefore, what does at the money mean? If out of the money is one where you would actually make a loss by exercising the option, buying it and exercising, then what is at the money? No profit, no loss. Okay, if you make it, so here if we round it off and say that the underlying is at 59, here the at the money would be here. Okay, so at the money over here, okay, you can see 59 call and put, both are at the money. Now one more thing to notice here, okay, so the other thing to notice is, now when we set the 61 call, because the underlying is at 59, we set the 61 call is out of the money. Okay, what about the 61 put? Is it out of the money?
No,
What is it?
in the money.
It's in the money, because 61 put is different, because now it gives you the right to sell at 61. So if I now immediately buy this 61 put at 746, okay, and I immediately exercise the put, therefore I sell the underlying at 61, and I can buy back at 58.60 or 58.70 or whatever, at 59, which we have been rounding up to 59. So now I can pocket a neat profit by exercising the 61 put immediately. So the 61 put has a positive intrinsic value. Okay, so therefore you can see immediately that the price is higher than that of the call. Okay, there are basically, you can see clearly that the extra price essentially reflects the extra intrinsic value of the put. The fact that the call is out of the money, but the put is actually in the money. So the put is the opposite of the call, and vice versa, right? Is this clear? Because the put gives you the right to sell, so you would be happy to sell at 61 when the market is at 58.60, right? So you do that, you can pocket some neat profit. So therefore this reflects both. It reflects the time value and the intrinsic value, both. Is this clear? Okay. Now one more thing you'll notice when you mouse over this, you'll notice that there's 34.445%, and it is 33.9%, let's say, and 34.5, let's say, and 33. Can you see that percentage figure?
Yes, sir.
Okay, whenever you mouse over, you will see this is 34.49, 34.5, 33.9. You see this is similar, 33.9, 33.9, 34.5, 34.5. Okay, these are what is called, this is the implied volatility. Okay, so we'll deal with this later, but there's another important form expression that you need to get familiar with, that is called implied volatility. Implied, you understand? In mathematics we write this expression saying this implies, we write it like this, right? Implies. Okay, in that sense, implied, that is past tense. Okay, so we use an expression called implied volatility, which I will now heretofore I will refer to only as IVOL. I'm not going to say implied volatility all the time. Okay, so we will have this concept of IVOL. Okay, so we'll see what this is, but what you should understand, if you wonder when you're looking at the prices, these are the IVOLs. Okay, essentially IVOL, I'll just give you a brief introduction to IVOL. IVOL is nothing but essentially it's the vol input that you need to enter into your option pricing model. Okay, it's a vol input that you need to enter into the option valuation model to produce call and put option prices which are equal to the current market. Okay, the current market, suppose you are valuing this option. We put in all the parameters of this option, and I'm not getting a call price. I'm not getting a call price of 3.31. Okay, let's say we are looking only at the offers. Okay, I'm not getting a call price of 3.31. If everything else is correct, okay, 180 days expiry, underlying price is correct, everything is correct, but the market price is 3.31, but my option valuation model is showing me some other price for the call option. Well, the answer is you have to see what is the I-vol in the market price, implied by the market price. So it's 34.5. So the meaning of this I-vol is, well, if your option, your OVM, option valuation model, is not giving you a price output here which is equal to the market price, okay? If you're not getting that equivalence, then what you have, the vol input, remember vol is one of the inputs in the model. This vol is one of the inputs. If you enter the vol, you look at the market price display, you will see in professional trading systems, you will see the vol display, okay? You check the vol from here, it's 34.527. If you enter 34.527 here instead of 25, then you will get, if everything else is correct, then you will get the same price out. This price output will become, this price output of 3.019 will actually become 3.31. That's what I-vol means in a nutshell. We will have a more discussion, actually, because I-vol cannot be discussed without reference to historical volatility. We have to also discuss another thing called H-vol, which is historical volatility, okay? So we will discuss all that later, but the point is you need to understand that this, because you are seeing this right now when you open your trading systems in the night, okay, you'll see that as well. And Hardik has already started packing his bags, so he has taken over the role from Garvit. Okay, all right, so the time is also up, okay? So we've so we learned something today. So please make sure now, 1 minute, one sec. So please make sure you've understood these terms. I'm not going to cover once again, okay? So intrinsic value, time value, out of the money, at the money, in the money. In the money means intrinsic value is positive, you'll actually make a nice profit. Okay, is this clear to everybody? And I-vol also, you learn how to check for I-vol, and you have a broad idea of I-vol. Okay, okay, fine. Please do the exercises I told you. Please make sure, Gulati, log in, create IDs, move. We have to move these processes quickly. I find many of you guys, I find that you are not actually